Hello, everyone. Welcome to the weekly roundup. Today, we will cover some macroeconomic updates, precious metals, and earnings releases. Hello, Ben.
Hi, Eva.
How's it going?
Oh, well, going good, but lots has changed in a week.
I feel like there's so much to talk about this week.
Yeah, absolutely.
Maybe we'll end up doing like an hour session.
Definitely possible.
Okay, we're going to start off with Kevin Warsh emerging as a potential new Fed chair nominee. What could his leadership mean for the future path of interest rates?
Think that's a great place to start because I think his official nomination, really started, I think, the rout of the silver and precious metals market. Um, not sure that he by himself is the reason for it, but certainly his announcement and nomination was a catalyst that everyone pointed to as a reason for this correction that we're currently in the middle of. So I mean, as per a lot of these people that have been bantered around about who could potentially take over, he's come in with fairly, you don't know too much about him, except for people go back and look at while he was part of the Federal Reserve before. What did he do? What did he vote on? What did he think about? I think the market, at least so far, has interpreted him as being more hawkish than they would have thought from the potential new head of the Fed. And so effectively hawkish would mean that maybe they don't cut rates as quickly, maybe they continue on with quantitative tightening, which is buying not as much buying of assets and letting them roll off the balance sheet, continue to shrink the Fed balance sheet. So he talked a lot about that in his past. I'm not certain that that's the case, that he's going to be that way. President Trump and his teams would have most certainly interviewed him prior to this nomination. And so I guess there's really two schools of thought here. One, he continues on with what he's done in the past and voted on, potentially more hawkish, that gives President Trump a scapegoat if something bad happens in the markets. Or two, which I think is more the likely outcome, is that he will have said something along the lines as we're going to cut interest rates and we're going to flatten the yield curve and stimulate the economy. Because if you look at the other things that Trump's been saying the last little while, is we need housing to accelerate. And the only way that housing accelerates is interest rates on the long end come down. Trump has taken over some of the supervision of mortgage debts in the US, so maybe that changes, but I'd be shocked if he isn't a Fed chair that leans in the direction of what the politics of the time needs.
Okay, we're going to stay a bit more on macros before we go to precious metals.
Yeah.
Um, Canada's services PMI suggests the downturn is deepening. What does this usually signal about, economic momentum, jobs, and, generally for the path of interest rates in Canada?
So great question. I think it leads typically, at least in the past, it's led to increased unemployment, and a weakening jobs market. We've had a fairly soft jobs market in Canada. So I think the one thing that surprised me a bit about this, when you couple the jobs numbers plus the PMI, to your point, I'm a bit surprised we haven't seen more interest rate cuts priced into the market. If you were joining us for our update last week, we indicated that many of the chief economists for all the banks are effectively saying no interest rate changes in Canada until Q4 of this year. You know, the combination of these two, unemployment rising, inflation falling, and PMIs falling, would suggest that the economy is slowing. And so that would also suggest that rates need to come down. And if you look at the forward market on the rate curve, it's actually quite flat. It's maybe 5 basis points higher than where we are today. So I still of the mindset, if these numbers continue like they are, to your point, is we see further rate cuts in Canada, because really that's pointing towards a slowing economy. Canadian market had a good year last year on the back of financials and gold. Um, I don't know that that continues from this point, so I'd be leaning towards the fact that it's pointing towards the economy slowing and interest rates probably falling.
Okay, let's go to the interesting stuff. Precious metals were in a frenzy on Friday. So was this shift fundamental? Is this forced selling, margin calls? What happened, and how should investors think about metals going forward?
Yeah. So what happened? I think what happened was many-fold. And as we talked about last week, right, when I did the presentation on Thursday, we'd seen a bit of a crack in the market, but nothing material. We did peak out sometime Thursday morning, maybe 10 or 11 Thursday morning prior to our meeting. And I said during the meeting that the technical case was pretty bad, overextended to the upside, sell signal, so to speak. And so the view and the thing I said at the time hasn't changed too much is the fundamental case hasn't changed. That's the problem. That's the point. And I guess when you think about the market, there's two parts to it. Is your fundamental case intact and or is the technical setup right? So the technical setup was brutal, and so we saw overreaction to the downside as a result of that technical setup. The fundamental case, well, nothing's changed from last Thursday. There's still currency destruction everywhere in the world. We have seen a couple of central banks move against current views where Bank of Australia actually raised rates this past week. But for the most part, we're getting towards lower rates and destruction of capital, which would be the bullish case for gold and silver. So the fundamentals haven't changed much, but the technical side got completely destroyed. And so when you have a technical takeoff like you did with gold and silver, and definitely silver in the past 3 weeks, where you saw a vertical move on it. I mean, it's driven by speculation. And so, technicians look for breakdowns and breakouts. So if you're a technician, you go, okay, well, gold's breaking out. This is the all clear signal. Buy the breakout. Well, that works until it doesn't. And when you get a breakdown, it's too late. You haven't had a chance to react on something that moves as violently as silver does. And so this has all been technical driven. So somebody lit the fuse on Thursday, and then on Friday there was margin calls. There was most certainly hedge funds that are now out of business that we don't know about or haven't heard about yet, that they were leveraged 20, 30 to 1, and they got margin called and they sold. They had to sell everything. So you saw massive selling pressure on silver, on gold, on the companies, which has rolled over into selling pressure on AI and tech and crypto. And you've just seen a rollover effect as liquidity is getting sucked out of the markets. And so, again, fundamentals, nothing's changed. Economic, nothing's changed. But the technical side, you're seeing a huge liquidity flush out of the system.
Watch the charts.
Watch the charts. Let's watch the charts. But for us, um, what it did was we had liquidated a lot of positions on gold and gold miners prior to. We've taken advantage of the rallies yesterday and the day before to lighten up some of the positions that we weren't able to get out of. So it took advantage of the bounces and further reduce precious metals exposure. So still have a bit of gold and silver and one miner, but generally taking advantage of having a move up of multiple hundreds of percent to lock in those gains and take action because the market right now, especially from a technical perspective, needs to rebuild. And
Yeah.
so we saw, violent move down, violent move up, violent move up yesterday, violent move down today. I mean, the market needs to find its footing now, and finding a base is very volatile and very painful if you stay in those positions. So, I think 2/3 of the gain was made, And, if we get a new higher high, great, and you still own it, take advantage of it. But, there's a new base that needs to form, and the technical piece of it is pretty bad, and it's going to take some time to rebuild. Once liquidity comes back, we'll see a big move up in a lot of things. But right now we're seeing selling across the board.
Okay. Switching to the tech space. Anthropic's latest AI tool is getting a lot of attention. Is this potentially going to cause a disruption in that space?
Hmm. So I think coupled that with the overall general liquidity flush was really bad timing for a lot of things. And so I think the answer is yeah, like Microsoft, Google, um, Nvidia, ARM, AMD, like all these companies that flow into the AI space were negatively impacted from the market liquidity issues. And then Anthropic came out with, we'll say, potentially a better and cheaper product. Hypothetically, I don't know. It's still early days. I don't really I'm not really of the opinion if it's better or not yet. Even Thomson Reuters, which is one of the biggest news sources in the world, where a big part of their new division is legal AI, which sells into the governments, including the government of Canada, uses their tool. There's this fear that, okay, everyone's going to go over to Anthropic now. So I mean, I don't think that's the case, but the timing of the two of them is another reason to sell. Is AI, we'll say tech, completely done? I think the answer is no. It's just the timing of liquidity is getting flushed out here. When we do see a recovery, then they probably participate back to the upside. But yeah, Anthropic's grabbing attention, timing of the announcement and the liquidity in the market's been bad, but that for us is great. That presents opportunities to add to positions, to deploy cash, to take advantage of the market reacting this way. But yeah, it was the announcement of the two, liquidity and the timing, wasn't great for we'll say, the AI story, present short term.
Okay. So earnings season is still underway, but with all the noise generally in the markets, did anything catch the market's attention so far?
Yeah, look, a quarter ago, if Google came out and said they're going to spend X amount of money on AI, the market would have rejoiced and stock would have rallied. This quarter, they announced they're going to spend more on AI. The market doesn't like it and stock goes down. So, I think it's just kind of the that caught my attention to some extent. Stock misses, like even small marginal misses, like Estee Lauder came out today, luxury brand company, stocks down 25% today. I mean, again, like it's an overreaction to news. And again, Capri was out earlier this week, similar overreaction to news. And we'll say, I'm not even saying a small miss, but there just something within the quarterly call where the market wasn't happy with. And so I think that has caught my attention a bit, is maybe it's going to be a quarter of, you know, market releases, overreaction to the downside, buying opportunities. That's how I'd be viewing it now, as opposed to the last couple of quarters, in line, good forward guidance, stocks took off. This is the opposite right now.
Okay. Let's see the charts. Alban, I think you're a little frozen up there. Okay, seems Ben is having a bit of technical issues, but he should be right back in shortly.
2 weeks
Ben,
in a sorry, two weeks in a row. It appears that the powers that be don't want to share my slides.
yeah. Okay,
Uh,
let's
just
try that
let,
again.
yeah, let me know when we're up here.
All good. You
Okay,
may just wanna take us back to the top.
okay, super. All right.
Okay, awesome.
Fe- Excellent. Thank you. February 5th, 1:15. We will give you an update on what's going on for the past week. As always, the opinions do not necessarily reflect with those National Bank Financial. Any discussions, questions, risk tolerance, anything that applies to you directly, certainly speak with myself or Eva or your advisor, and we're happy to address if any of these things are appropriate for you and your goals. So let's jump off at the start. At the heart of heightened political tensions, crude oil production. And so I think as we've looked around the world, it's hard to believe that we only are through 1 month of the year, given all the things that have transpired both geopolitically and market-wise. But here we are. So crude oil production, it's interesting to see what's happening and where and the increased production is coming from because the US has become a major producer and Russia and Saudi continues to be there, Canada, Iran, UAE, Venezuela. So crude production continues to be on an upward trending trajectory, and the US has become a major producer. And I think that's interesting just to consider what that means, big picture. So I thought this is a great chart visual just to see the scale of production that they have relative to what we've done as well. And our production continues to go up, but the price of oil hasn't moved. So if you do think there's a material move in oil, this could have an impact on these countries listed here. Venezuela probably has the most upside from a perspective of increasing production, given what's transpired there so far this year with the new leadership in place. So oil production across these countries, interesting view, and how that has gone up and materialized. So off the top, Eva, we talked about the move in precious metals. This is the materials sector down 10% last week, having become a heavyweight in the TSX over the past year. If you remember some of the slides we went through last week, one of the slides I pointed to was gold as a percentage of TSX was back to the 2011 levels. And I said when we got up extended to these levels where you get concentration in these names, that is part of the reason why TSX had a good year last year, but also part of the reason why we're seeing major downward pressure in the TSX presently right now, down another 400 points today. And from a year to date perspective, I guess this was last week. Okay. So last week, 10% down on the material sector alone. Here's the weighting breakdowns, which I referenced energy, financials, and materials. My view at the time, which continues to be my view, is we probably see a rotation from materials up to energy. Financials, we'll see probably a bit of a rotation out of financials as well, frankly. But I think we get a bit of a rotation where we start to see a shift from materials potentially back to energy. So but last week, you'll see the update on where the breakdown has come. Then on a month-to-date basis, you can also see those numbers year to date. Year to date gives you a breakdown of what's working, what's not. And I think when we look out on a 1 year basis, this number here is should be signaled to you as to why the market got overextended. A 1 year number of this magnitude makes no sense from a technical perspective. I understand again the case of the fundamentals, but from a technical expectation, that move was material, pardon the pun, and we move on to that, and I'll stop talking about it. Next one is rates. So as I talked about this off the top, We got a number of things lining up, which is unemployment is rising, inflation is falling, PMIs were also falling. So when you get a number of these things happening in concert, I would have expected these numbers to be a bit different. So we'll get an update on Monday of next week to see what this looks like. But I wouldn't be surprised to see this start to tick more towards cuts in the March meeting ahead, given what's going on. Obviously, lots of ground to cover between now and then, but given the number of things that we've seen so far and the shake that started to occur in the markets here, I'd expect these numbers to start to move towards cuts. The US one, they obviously give a tremendous amount of forward guidance. So if you look, they still are anticipating a couple of cuts over the next 12 months. If we get inflation continuing to fall and unemployment continuing to rise, I think we'll get this start to move quite quickly towards cuts. I don't think this is priced into the bond market today, which is part of what I discussed with you last week. And I believe makes sense to have some exposure into the bond market, given the fact that it's presently not priced in. And really, with the market correction so far, bonds have only moved up a little bit. And so that'll be interesting to watch and track. As I mentioned, the opinions do not necessarily reflect those National Bank Financial. I appreciate you looking at and seeing our charts today. If you have any questions, give us a shout.
Okay. Thank you, Ben.
Yes.
So what's on the agenda for next week?
Yeah, so I think that there's a lot to pay attention to and see how the back end of this correction in the markets have happened. Do we see markets go sideways into this, or do we see more choppiness? Volatility hasn't spiked as much as I expected, so I'd be paying attention to that. One big nuance which we didn't talk about is there was a huge spread between what the value of some of these ETFs were worth, what's a net asset value versus what they're trading at in the market. And at one point, SLV, which is the largest traded silver ETF in the world in the US, traded at about a 20% discount to net asset value. And so it's still present, not as wide. So I'd see if that gap closes and we start to move back towards those levels, which will give us a signal that there's been some fix being created into the system. We're seeing kind of a closing of the gap and a normalization, we'll say so to speak. So next week I'd be looking to see if there's normalization and that follows through. And I'd say that's where most of the time and attention would be, as a result of taking profits in a number of things in January and December. We'd be looking to deploy money. So I'd be looking to see what's been hit the hardest over the past few weeks and use some of that cash to take advantage of it.
Yeah. Okay. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video. And if you missed our annual outlook last week, the playback is up on our YouTube page. You can go watch it as many times as you want. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you once again for listening and enjoy the rest of your day. Bye.
Thanks, everybody.